Today's episode is for educational purposes only, and it is not a substitute for professional tax advice. Hi everyone, welcome back to another episode of Let's Talk About It. Today I'm here with Denzel Luna, a former basketball player at Bridgeport, now getting his master's in accounting at Wake Forest, and the founder of Nexa Tax. I feel like when I talk to athletes or just like young people today, all you hear, and Denzel, you probably get this too, all I get is like, they don't teach us the important things at school. We don't learn about money or personal finance or taxes and whatever. And it's like, okay, that's true, but that is not an excuse for not learning it, because you're still responsible for it. And especially these days as athletes, whether you're a college athlete, a professional athlete, and honestly now high school, taxes is going to become a topic, if it isn't already, that you're going to have to be spending some time on. And so as we're kind of in the middle of tax season right now for all the listeners who are watching like right when the episode goes live, but I thought it would be an important conversation to have on the show as we begin our season 3. So let's just start off, Denzel, with you introducing yourself a little bit more. I already mentioned Bridgeport and Wake Forest, but I want to hear more about Nexa Tax and kind of what you're doing out there.
No, I appreciate it. Obviously, I appreciate what you're doing with this platform. I think this is a big topic, obviously, that taxes is inevitable. And so it's very good that, to spread awareness for athletes. So a little bit about me, like you mentioned. So I played college basketball at University of Bridgeport up in Connecticut. And there's when I kind of found a niche within taxes. I wanted to stay within sports and just find something that I knew I could work with athletes with. And that's what taxes was for me. And so from that moment on, I kind of just built different experiences, filing tax clinics where we were working with international athletes, doing different internships. And that's kind of as NIL was unraveling. And so as that opportunity came about, a lot of my friends and former friends and teammates in high school started receiving NIL income. And I began to have this knowledge that a lot of them didn't have. And we started to see that, they weren't given these resources to know, what they were going to owe in tax, that they were actually going to owe tax. And so that's what kind of birthed this, idea of Nexa. And this has led on into now, obviously, like you said, I'm getting my master's in accounting, focused in tax consulting here at Wake Forest. And so that's been able to kind of build up, the knowledge side and then also continue to build Nexa. And so what we do with Nexa essentially is we try to simplify taxes for athletes. So we try to act as the middleman. The moment the athlete will get paid to the moment they have to file their taxes, we're with them every step of the way. And just to make sure that they're organized and they know what they owe come tax time, that, they're not caught with any surprises.
That's awesome. Like, I think we share that thing of wanting to give information and also give resources to help people once they have the information.
Yeah.
I want to get started. I mean, I think everyone have heard of taxes and kind of what they are, but I think it would be, if you can, good to kind of get remedial with it and just explain what taxes are in the sense of like your age and like who you are as a person. Because I think, especially for me, growing up, like I always knew, of course, taxes were a thing, but I thought that was a thing like for parents or people who have like a
Yeah.
9 to 5. Like, how does it apply to the people listening to this episode?
Yeah. So taxes is in a most basic sense is something that everybody's paying all the time. So you pay taxes, not even think about it. When you go to the store and buy something, you're paying sales tax, property tax. So there's a lot of different taxes, and it's essentially how the government is making revenue in their primary way. Their most primary tax is income tax, and that is what concerns all the athletes. Basically, that regardless of age and regardless of who you are, you're going to be able to pay or going to be liable to pay taxes on your income. And so that kind of, they take out, the age. So, if your parents are claiming you as a dependent, if you're still living with your parents, but you're making income, the government is looking at you as saying, hey, you made this income, so you're going to be owing this tax on this income. And so that's essentially in the basic sense what it is. And like I said, the income tax is its biggest revenue for the government. So they're pushed to make sure that they receive that share of their revenue, and it goes to things, basic things, obviously public transportation and schools and things like that.
So I just have a list of questions here that I kind of pulled from conversations with friends and also just
Of course.
seeing what some of the common issues are. My next thing was, so you're saying, okay, like even if your parents list you as like a dependent, or even if you're maybe a minor, you still could
Mhm.
potentially have to pay taxes. Okay, is that correct? Okay.
So, because think about like if you were in high school and you got a job at, let's say, a part-time job at Chick-fil-A. Chick-fil-A is paying you, and what they're sending to the government when we get that W-2 at the end of the year is saying, hey, Denzel Luna received X amount of dollars. And so typically what we see is obviously prior NIL, most of these minors were getting jobs that they wouldn't really meet income thresholds where they would owe, which I'm sure we'll get to. But now obviously with NIL and now there's a lot, athletes are liable, and that's one of the big misconceptions, that, hey, my parents are claiming me as dependents, I live with them, I don't owe taxes, and that couldn't be further from the truth. So
Okay, so there's a couple of words you said I wanted to find. So the first was the income threshold. So this was definitely something. So I don't know where people are getting this, but it's like a really common thing. I hear athletes say like, "Oh, I made less than $1,000, or I only made
mhm.
100, or I did 10 $100 deals." That doesn't count.
Yeah.
What is actually at what point do you actually have to pay taxes?
Yeah, so like we mentioned, there's different types of tax. So there's when you think about income taxes, there's two buckets, and so it's called W-2 income and then 1099 income. So W-2 income is when you have an employer and you're an employee. So your regular 9 to 5 job or a part-time job where you're an employee and they'll withhold your taxes from your paycheck. That is typically the most common type of income. But then you also have this 1099 income, which is 99% of NIL income, which is non employment compensation. So think about an endorsement deal where Dunkin' Donuts is saying, hey, we want to bring you in. Now it's a matter of I'm only with them for a short contract, a short time. So technically, you're not an employee. They're just paying you as a non-employee contractor. And so once you get into these two buckets, there's two different thresholds that should be concerning as an athlete. So you have your standard deduction. If you're a single filer, it's this year it should be 15,750. So if you make under $15,000, $750, you would not pay federal taxes. So that's when that threshold comes into play. Typically, if you have just W-2 income where you just have a 9 to 5 or a part-time job and you only made $10,000, you're good. You don't have to pay any taxes. Normally, people will file their taxes just to get their money back that they withheld from for taxes. The biggest misconception that happens with student athletes is they say, "Hey, I made a $1,000 NIL deal. Now I don't have to pay taxes because I didn't meet that threshold." And that threshold changes every year. Last year was 14,600, so it kind of goes with inflation. And if they don't meet that, they kind of think, hey, I'm done. I don't have to worry about it. But that other bucket, what we were talking about with 1099, is when it introduces another tax called self-employment tax. Typically, your employer, if you're an employee, will pay your share and their share of that side of it as an employer. It's 15.3%, which is split into your Medicare and Social Security. So things people don't think about, right? We always pay our fair share. So your employee and the employer will pay both sides. So now that you're a 1099 employee, it's on you to pay both sides. You're paying the side of the employer and the employee. And this is kind of more in depth with it, but essentially what happens is now you're paying this additional tax to your federal tax what a normal W-2 employee would pay. And so that threshold is $400. So now you see things to really change because you obviously think, hey, I didn't make $15,000. I'm good. I don't have to worry about it. But you still have to pay self-employment tax. And so that's one of the biggest pitfalls I've seen athletes fall into, especially getting these smaller brand deals that they're not making insane amounts of money. And they're surprised that come year end, they get a 1099 in the mail or on their phone or email, and they have to owe. And so obviously it's not a ton, but it is an amount because nobody's withholding. So you have to be weary that not all that money is yours. So
Yes, story time. My first, my very first job was at Pottery Barn, the like freshman ish, like sometime around 2020, 2021, like my freshman year of college. And that was W-2. And so I remember getting my first check and being like, I had been calculating in my head. And I get my check and it was so much less than I thought. I was like, what
yep.
is this? I was so mad. But I was like, okay, like I can plan like I'm getting less money. But then my first time ever getting like a 1099 form was also really jarring because I didn't I had already had the experience with the W-2. And so I had
Hmm.
assumed like the taxes and everything that I had was already kind of being taken care of. And I made so much money. And then I was like, oh crap, like I had no savings. Like I had nothing. And so I love that you're explaining this, and like this is why it's so important for me to share this because athletes think like, oh, I made 10,000 in NIL, like let
Yeah,
me go buy that spring break trip or let me go do that. Like, hey, I've almost been there, and then April
yeah.
comes around, and you owe $600, $1,000, like whatever it
Hmm.
is. Like in the grand scheme, it doesn't seem like that much compared to what you made. But when you had no idea you were gonna owe that, and
Yeah,
you waited until April 1st to start filing, you're like, oh great, I have 2 weeks to come up with money and send it to the government.
yeah.
Um, it's scary. I want to ask a little bit more now. I know you have Nexa, but just in general, like when the 1099 forms come, or as people are doing this kind of self-employed um, work, when it comes to those 1099 forms, can you just explain maybe the process of when they come in to you ultimately paying that tax, like whether it's online or however you pay, um, and then also just explaining maybe if you have any advice on how to keep that all organized and like what you should be doing throughout the year.
Yeah, yeah. So essentially, when you're going to receive this 1099 is come the year end. So it doesn't happen right after you get this deal. So let's say if I got this a deal, this month in March, I wouldn't get my tax form till the following year. So you're looking at around January, February. Different employers do different things. Obviously, the more bigger corporate companies have a certain date. Um, but they're always within January, February timeline of the next year. So right now, this year, we're filing 2025 returns. So most everybody should have their 1099s from the previous year. Um, Typically, once you get it, you'll know what you made. So you'll kind of have it'll be exactly it'll say, hey, this is what you made for this deal, and once you receive it, it'll come either via email, sometimes the mail, and that's important because a lot of athletes sometimes will be like, hey, I didn't receive anything in the mail, I'm good, and it's like no, check your email, or you might have to email them, because one of the key things here is if you receive a 1099 or W-2, the government is receiving one as well. And so the government has a transcript, an IRS transcript that they see exactly what you made. And that's where kind of the pitfall comes of, hey, they know what you made, because when an employer issues it to you, they're also entitled to issue it to the
Mm-hmm.
government as well. And so once you get that 1099, you'll already kind of know, like I mentioned, what you owed. And so that's when you start to think of ways to legally reduce it, which there are several ways. And one of the main ways, obviously, is tax deductions, which I'm sure we'll hit on. But that's kind of the main goal of saying, hey, look, I have X money set aside, which the hope is you would kind of set aside a portion of what you made to, know, hey, this all isn't my money. And then the second thing would be kind of think about and look for receipts, which is this is obviously better right after when you get it rather than a year after. But then figure out what things exactly apply that I can directly deduct, for this amount, which will lower how much I'm going to owe. And so those are the main things of kind of the process that you want to kind of do right before filing. And then I'd say is what we built at Nexa was exactly for this, is to kind of keep you organized. And so come year end, you're not scrambling for receipts. Once you find out, hey, this could actually save me money and it's not just a loose piece of paper. But there's other resources as well. You could obviously always take pictures on your phone and save them to a folder. There's different resources such as QuickBooks. So Next is not the only thing out there. It is a resource, but there's other things you can do as well as bookkeeping, just to make sure you're organized. And that's the biggest thing I'd emphasize, to say, hey, make sure you have your receipts and understand this is going to help you in the long run, even though it might be tangible now. But yeah.
I love that. And I'll also ask, I think something that's come up is one, I love the idea of just organizing and writing things down. Like the early days, I just had a note sheet of every time I made
Yeah.
money or had a deal, and then at the end of the year, I was able to like show that to someone and like go down the list,
Yeah.
and like organize the 1099s too. But something I've noticed, and I this is something that comes up on the show all the time, is NIL isn't 100% perfect yet, and it's not 100% like organized. And so I feel
Mhm.
like there's a lot of times, and I've had this too, where I've done NIL deals or I've done just deals where I was like an independent contractor where I actually wasn't sent a 1099 in the end.
Yeah.
Do you mind explaining, what people should do if they don't get a 1099 or something like that?
Yeah. No, for sure. I think the first thing obviously is kind of reaching back out to them saying, hey, especially if you know you crossed the threshold. So the threshold is $400. So if you got a $250 post, you're good. Um, the matter is if you got additional deals and then now you kind of, so if I got three deals that were $250, now I crossed the threshold, now I have to report it. What you did is exactly right. You have to understand that you have to kind of, obviously the government and the tax system is built off integrity, and so
Mm-hmm.
obviously filing on your own, and so that's what you would want to do. The government expects you to still file and report the amount, especially if you cross that $400 threshold, because you do have to pay, your self-employment tax. And God forbid, you don't want to be in a situation that you did actually owe, and even though you didn't receive a 1099, they sent one to the government, and now the government's holding you to it. And so the safest thing to do is do what you did. Obviously, report the income from exactly what you owed, and then you pay your fair share of taxes so you can not be held liable. One thing I'll hit as well is the government has up to 3 years to look into you and audit you. So, I could be receiving a 2023 notice from the IRS tomorrow, and that would be completely fine. And the other thing that continues to go deeper is once they find a notice and then they say, hey, this tax return doesn't look correct, now we're going to look at all your prior years, and they have full discretion to do that. And so you don't want to put yourself in that type of position of saying, hey, I'm liable because there's all these 1099s that I didn't file, and now I'm going to have to pay the tax plus any penalties and interest, in addition to that. So
Oh man, I want to get into this for a
yeah,
second because there is so much anxiety. I have one other question about the forms and what you owe. The
of
last
course.
thing is just product. And a lot of athletes now, their deals are in kind. They're getting free coffees, acai bowls. I had a deal for a long time where I would just get clothes and I just posted about it.
Yeah.
Does that also get reported, or how do you
Yeah.
talk about that?
So that's a big misconception. More athletes obviously will think, hey, I got these free 5 pairs of shoes from this brand and I'm good. And then come tax time, they'll get a 1099 and they'll be surprised because it wasn't cash. Essentially, how the government looks at it is the fair market value. So if the fair market value was over $400, um, and normally companies will still issue 1099s for it, you'd have to report it. And so it's not just compensation within cash. They view as compensation as well as it could be that you getting, this free gear, that I mean, it could kind of make sense that, hey, if I'm getting 5 pairs of Nike running shoes that are, $200 each at a store, um, they're gonna hence to do that. And so we see that often a lot with obviously cars when athletes get brand deals with cars. That's obviously in the bigger sense, but like you mentioned, obviously with makeup and all these different deals, just know once you're kind of around that threshold, and you can kind of tell and say, hey, this is worth a lot of money what they're giving me, even though they're not paying me. You can kind of expect a 1099 come at the end of the year, knowing that this is all, I'm going to have to pay my fair share of taxes on this.
Oh, one other question before we get to
No, of
the
course.
craziness of the anxiety. I know I was no nervous the first time I filed my taxes. What is there a kind of like a set percentage for the 1099 income that athletes should have in mind that they're saving for each of these deals?
Yeah, so there's two different ways, I guess, to address this. Typically, what people will tell you is save 25 to 30%, which is a general rule. Obviously, the reason why it's always general and it always depends is because you have to take in factors like what state do I live in? Is the state I live in high tax state, for example? With somebody getting paid in California versus Florida is going to be a completely different amount, right? And then in addition to that, it's how much money that I made in total. So if I only made $5,000, it'd be a completely different amount if I made $100,000, right? And then the type of income that I made 1099 plus W2. So there's a lot of factors. So the general rule would say, hey, save 25 to 30%. Now there is an alternative, which is called the safe harbor rule. The safe harbor rule was built in place to be in positions that if you're an athlete, like, hey, I don't know exactly what I'm going to owe. I don't know if I have a big game next week, I might get a big deal. The safe harbor rule was put in place to say, hey, it may not be exactly accurate to what you're going to owe, but you're going to be fine with the IRS saying, hey, I'm not going to get any penalties for underpayment. So essentially what the safe harbor rule is you can either pay 90% of the tax you're going to owe in the current year. So if you have a good idea of, hey, this is what I'm going to make, I'm going to make $10,000 this year, the government would expect you to pay $9,000. If not that, you could pay 100% of the tax you paid last year. So you say, hey, I'm just going to pay exactly what I paid last year prior to the tax season. So I'm already in a good level. Or there's a higher income threshold. So if you made over $150,000, you pay 110% of last year. And then the other fourth option is if you didn't pay taxes at all last year, you would actually owe 0%. You're not required to pay upfront. And this is more estimated payments, but this is a way to kind of say, hey, I'm good. For this year, I've been able to pay my fair share up until I file, and then I find out exactly how much I owe. And this is a good way to kind of be prepared and already have a good chunk paid before you file your taxes.
Okay, so I think now we've gotten into the part of I think the basics that everyone needs to know. Yeah. Essentially, hey, if you just did one $400 deal today, or you are in a Nike ad. I want to talk though about the penalties and things like that, because I think that's something that a lot of people are afraid of, and it's so important to me to talk about this too, and do the education of it, because I think in a way, taxes for a lot of young athletes will probably be one of their first real big person things. Probably whatever contract they sign for their athletic scholarship and or NIL, and then paying taxes. That's your first big oh, I'm an adult thing, and it can be really scary that you're going to make a mistake. What is the actual reality of, I don't know, what's the severity of the consequences, and the reality that you're really going to get in trouble doing this?
Yeah. So in reality, obviously, there's always the factor of materiality. So if somebody owed $3 million in taxes and did not pay to the IRS, that's a big red flag compared to if somebody underpaid $10 in tax. So you have to understand that as well. Other than that, I'd say when you want to think about, okay, what about these penalties, there's two different types of penalties. So there's a penalty if you failure to file. So you simply filing tax, and then the failure to pay. So the failure to file is a 5% per month on what you owe. So if I owe $2,000 in taxes, it'll be 5% of that. But the max is 25%. So it's capped out at 25%. And then that's a failure to file. So obviously that's more aggressive. That's 5% a month. And then you have your failure to pay, which is 0.5%. So 0.5% up to 5%. And obviously that's more slow. And there's more grace there because it's saying, hey, thank you for filing. We know what you owe. Obviously you haven't paid it yet. But now you're in a place of you're kind of good, but just make sure you pay what you owe. And so the IRS does a decent job at it as well. They have payment plans as well if you don't have all the money up front that the IRS has. So there's kind of different ways to obviously navigate that. But the main thing is obviously considering the penalties, you want to make sure you file, because 5% a month, it could mean a lot, obviously, if you're owing a good amount of taxes. And so those are the main penalties that you'll see. And like you mentioned, it's not like they're going to come randomly. And I think that's the scariest thing of oh, could they just knock on my door and they're going to take me in, right?
Take me away,
yeah.
1984.
Exactly. And there's yeah, that's definitely a misconception. So there's a series and there's a process the IRS has to go through, and it obviously starts with notices and trying to deliberate with you. And obviously that's when it's good to obviously have a CPA, especially if the income amounts is a lot higher. But it always comes down to, hey, this is what you owe. If you'll just pay it, then you can kind of, be set. And so it'll start out with notice. So you'll receive notices by the IRS. When you'll start to see things get escalated is when they've sent you several notices, and then you start to see, hey, you haven't answered. It's been years. That's when you can kind of expect to say, hey, it's not going to just, they're going to say, hey, we sent you 3 letters. They didn't reach out. So we're just going to go to the next person. Obviously they're going to stay on it, especially if it's a significant amount, because they're going to, the government's going to want their money.
So I have to imagine that there's some people listening to this episode right now who are realizing that they did not file their taxes and that they should have. I want to say that that's okay, but only you can tell them. What should they do right now before they eventually get, a letter from the government saying, "Hey, you failed to file"?
Yeah, yeah. And this kind of goes back to as well, like the 3 years. So obviously, if someone's like, "Oh, I didn't pay," in 2023, it's too late to file. It's never too late to file, and you can always file, and you'd be surprised as well. So obviously this is not every circumstance, but if you had a W-2 and they withheld taxes and you didn't file, so you might be surprised to say, hey, I might have some money that was withheld that can kind of offset some of my liabilities, so I don't owe exactly what I think I owe. But the main, simple advice I'd give is just file. Obviously, you can see even just by the penalties, the difference of penalties, there's a lot more grace for failure to pay. But as long as you file and you say, hey, I'm going to file this year, because if not now, it's going to happen in the future. To buy a house, normally they ask for prior year returns, 2 to 3 years. And so if you don't file it now, they're going to, say, hey, okay, go ahead and file your 2022, 23, 24 return. And it's just going to cost more money out of your pocket, especially as we get older. And so that's the main advice I'd give. And not to not pay, but know that there's grace that, hey, obviously the penalty is much smaller. And there's also, like I said, those payment plans that if you don't have the money right away, it's just best to file and then kind of cross that bridge when you get there.
Right. You don't have to panic.
Exactly. Yeah.
So we've talked a bit about, hey, like if you're making more, then get a CPA and try to find a professional who can help you. But it has always been, in my opinion, that you should know how to do things yourself as much as you can or as far along as you can. I realized that we actually haven't talked about the actual filing process. I think we don't have to go through the numbers and the boxes one by one. But are there any services or websites that you would recommend for people filing their taxes?
Yeah, obviously, it all matters of complexity. The reason why I say that is because if you're an athlete that has 10 NIL deals, is making over 6 figures, and then you also have investments and stocks, now you're dealing with a lot more complex tax return than if someone that says, hey, I just had one deal, I had a part-time in the summer, that's super straightforward. What I'd say is kind of like you said, there's enough innovation where not everything has to be through a CPA. If you made just one deal, you can go on TurboTax, and TurboTax will guide you through, as well as Tax Act and TaxSlayer. There's a ton of different services that, especially if it's much more simple, I think you can have confidence in that software to say, hey, they have different security systems and notices that they'll let me know if I filed this wrong. Now, when it gets more complex, which obviously if we want, we can talk about that more in depth. That's when you want to bring in a professional to say, help you with kind of not only organize everything, but making sure you're doing it for accuracy. For so long, I always thought a CPA's job was like the best CPA is whoever lowers the tax the most, and that couldn't be more from wrong. It's who does it the most accurate, right? You just want to be saying, hey, I just want to be good. I don't want to have anything with to do. I don't want to pay any more tax, any less tax than I owe, and go about my way. And so what you're looking for is accuracy. And so what most of these services provide, like TurboTax, especially for a simple return, which I'd say simple is 1 to 2, 1 to 3 1099s is fairly simple. That can be done within, a service like a TurboTax, that you don't need a whole CPA team. But obviously, once you cross certain thresholds like 6 figures, then that's when you'd want to, get more professional help.
That's awesome. Okay, so I feel like we're good. Like the people who are beginning, I feel like they're good. But I have to say, like as a professional athlete or someone who's like now running my own business and stuff, there's some points that I want to bring up just like for food for thought for the people listening to this episode.
Of course.
The first was I did want to get further into the deductions piece because this is something that I struggled with. It's like, wait, I've bought clothes and makeup for my speaking events and for the podcast, and I've bought all these items. Like, shouldn't these be deductions? Do you mind just explaining like what the deduction process is or what it is and kind of the different types? Like, I don't know. What I'm thinking of is like the people on TikTok who are like business expense. Like I showed my brand new Range Rover on TikTok, and now I don't have to pay any taxes.
Exactly. Yeah. The tax gurus.
Yeah.
So yeah, I always So essentially, what a tax deduction is you're saying, hey, Sydney, you got a $10,000 NIL deal to post on your story 3 times, and now for you to post, you had to go and buy a new camera. that cost you $1,000. What a tax deduction does is it's going to reduce the amount of what you're going to owe for taxes. So instead of you paying taxes on $10,000, you would pay taxes on $9,000 because you were able to deduct it. Um, what the IRS considers a business deduction is what's ordinary and necessary for business. The problem is that's so general that people can easily misconstrue it and apply their own idea and think these genius loopholes that the tax, the IRS obviously knows, like they're smart. They're not just taking whatever. So that's the key. I would say is this: when you're filing your taxes on your own, you want to generally be there's different thresholds of kind of confidence, and so it starts, the highest one is more likely than not, there's more of a 50% chance that this is a tax deduction, and that's what I would lean on, especially if you're doing it on your own and you don't have a CPA, because you don't know what they're gonna audit. You don't know how deeply they could view it. And so what I would say for this is being on the safer side. What that means is things that only literally directly relate to what I had to buy for, I could not have done this video without, you know, buying X, Y, and Z. So, camera, ring light, that can include subscriptions. There's a long list, but advertising, mileage. So there's a lot of different things that you can use as deductions. The key is not kind of trying to get creative with it, and that's where kind of that tax evasion comes into it. So, for example, when people start to say clothing, what the IRS considers a lot of that stuff is personal, and it considers that as, even sometimes makeup, they consider that as, hey, that's for your appearance, and that's, you care about what you want to look like for this video, but it was not ultimately necessary when you did this story. And so that's when it kind of crosses that line. And so, for example, when they talk about clothing, the big distinction, and you kind of go into this deep rabbit hole of like court cases, because that's when you can kind of see different positions people took, and so that's when it'll kind of go more into I'd get a CPA. But when they talk about clothing, they say, hey, we want to see a logo, like a Nexa logo, to prove like, hey, this is a distinguished logo, this is clothing, rather than if I go buy a designer shirt and say, hey, this is for my thing, it was, they're going to view that as more personal. And so boiling it down, though, essentially what you should know as a tax deduction is say what is exactly ordinary and necessary. And if I'm filing taxes on myself, I would focus to be on the safer side of saying, hey, this is exactly related to it, 100% business. And then when you bring in a CPA, that's when they can kind of take a little bit more risky positions, substantial authority, which is about a 40% likelihood, because hey, if they come back and ask something and then they want to audit or look at these deductions, I now have somebody that can kind of talk about their position and why they took that position.
Okay, and so now I'm thinking for myself as a professional athlete, the first thing is, what about training costs? Like, I have a gym membership, or I'm traveling to events. Like, there's a lot of I'm thinking of track athletes or the pro beach volleyball players, where they're not like getting their flights paid for by a team or traveling on a bus. Would those also be considered deductions?
Yeah. So that's when you're able to really file and use, things like airfare and lodging, is when it's coming out of your own pocket. That's the key. A lot of times what will kind of be a misconception is, your team will say, hey, go get this gym membership and then we'll reimburse you. And then you go try to write it off. It's kind of like, hey, you already got reimbursed. And so that's the biggest difference. If they're saying, hey, you have to drive to this place and back, now you can start using mileage. Especially as a professional athlete, you are the business. And that's the biggest thing you'll hear in NIL, saying, hey, you are the business, which is a pro. But especially if you're doing it yourself, like I said, generally you want to lean on the safer side and make sure to say, hey, these things I know for sure. I had to buy an extra pair of cleats because I have to go and train, and the team's not covering it. It was on me, but this is used solely for my business, which is me playing. And so, yeah, so there's a long list. Obviously, if there's a Schedule C on the tax return, and that will kind of lay out. There's a ton of things that you're able to write off. The biggest thing is making sure that this is directly applies to your business, and that it's ordinary and necessary.
And there's a lot to this tax stuff. One piece of advice that I'll give beyond our expert today is start early. If you are planning on doing your taxes on your own, Highly recommend giving it like a week to 2 weeks before that April deadline. And even longer if you think, oh, potentially I might want to bring in someone to like look over this, like a CPA or
Yeah.
like a service or something. Like I've been doing, this is maybe my 5th year now of paying taxes, and it's gotten easier each year, but also more complicated. Like it takes time.
Yeah.
And one problem that I had this year was trying to figure out, as an athlete playing overseas and getting paid in a foreign currency, like if I needed to owe taxes to the US, or like how I needed to write that in. Do you mind giving us some insight on that?
Yeah, yeah. Obviously, that working with overseas and pro athletes that play, it gets a little bit more complex. Obviously, more to depending on how much you're making, you obviously kind of want to save professional help just because. So what happens with foreign income is since you're a U.S. citizen, you're obviously still entitled to pay taxes. But the U.S. says, hey, we'll give you a foreign tax credit. And there's two different ways. So normally, if you're living full time, let's say you were playing in Germany full time throughout the year, you didn't even go on U.S. soil. There's a foreign income exclusion credit, which would essentially there's thresholds, but it'll essentially if you're making let's say not over 50,000 or 75,000, it would wipe that income out. And so obviously you still have to report it, say, hey, this is how much I made, this is how much I'm able to deduct, um, and just so the government knows. But there is incentives for athletes that have foreign income. The most common one is foreign tax credit. So if you kind of gone back and forth, you're only there for let's say 6 months out of the year, what you'll get is a foreign tax credit. And essentially, what it'll say is most pro contracts will it'll explicitly say if they pay net of taxes or if you have to if they'll take out of your paycheck, but that tax that you paid to that country will get deducted on your US return. So thankfully the US will kind of look out and say, hey, if you paid already $10,000 in taxes, you can go ahead and deduct that from your tax return in the US. So it gets a little bit more complex, especially if you're playing in different countries at different times, but just know that you're not going to have to pay entirely double tax on if I made 50K in Germany, I have to pay 50K in taxes in Germany and in the US. That they have that foreign tax credit for those athletes.
Denzel, well, before we finish out, do you have any advice, words of wisdom, anything that I didn't ask in this episode that you think our listeners should hear today?
Yeah, yeah. The one last thing I do want to hit on is one of the biggest misconceptions is the LLC. So especially if you're an athlete in lower income thresholds, getting LLC is really good for legal and structure. So it's more of a liability standpoint. But when you hear people say like, "Hey, now that you have an LLC, you can take these deductions," um, that's not true. So the way the IRS and the tax government sees LLCs is as a disregarded entity. So essentially, when you file your taxes, your individual tax, you file that LLC information directly in that return. And so it kind of just flows through to you from a tax perspective, not legal. Legal, it kind of separates you and that LLC. Um, so you can still take deductions even if you don't have an LLC. That's essentially what I'm getting to. Normally, what you would want an LLC still is you want to say, hey, instead of giving your social out to these different companies, you just give your EIN and it's kind of to the business, and you can kind of have a lot of things more structurized. But that's just one thing I constantly hear is say, hey, you get an LLC so you can get these business deductions. Like, no, you can still use your deductions even if you don't have an LLC. It's just now everything is to your name instead of it's going to X LLC and kind of having things split up. And it's a lot more on the legal side. And obviously, I'm not a legal expert, but that's kind of more for your protection rather than tax benefits. So just wanted to kind of clear that
I
up.
know.
So
I'm so glad you asked that, because that's true. When I created the LLC for Thrive, I thought, oh, okay, great. Like you always hear on the news, like
yeah,
corporations and businesses get these crazy tax cuts, and I'm like, oh, great. And then I actually filed the taxes this year, and I was like, why are you asking for my EIN right after my SSN? Like,
yeah,
this is supposed to be separate. It's not. So
exactly,
I'm glad that you
exactly.
brought that up. And we'll continue to have, and for everyone listening, we'll continue to have conversations on these topics, especially, starting a business, handling your finances and money and everything as we continue to do the show. Denzel, thank you so much for coming on the show today.
No, I appreciate you for having me.
Awesome. Okay. Hey guys, it's Sydney. I hope you enjoyed this episode of Let's Talk About It. If you did, make sure to leave a review and send it to a friend. Let's keep this conversation going. I'll see you guys next week.